we're going to go through questions we've already gotten, but if you have a question, please feel free to put it in the comment section. And if we get a chance to talk through it and actually answer that live here, then we will. If not, we'll put it on next week's if it's something that comes in later. So where we always like to start, because every week things are different in the market and we all know that it's been volatile, so we always like to start with just a market update and economic update, because those are two different things. And so Rob is actually going to walk us through kind of what's new and what he's noticing as we go through these slides. So I'll let you talk us through it, Rob.
All right. Yes. Well, the recovery continues is probably the best way to put it. It was for the stock market, it was another big week. It's down today, but the Tuesday, Wednesday, and Thursday were pretty good days. We saw the S&P 500 cross 3,000 again this week, which we haven't seen that since early March. So the stock market has come way, way back from where it was at the end of March. And we continue to see people and investors really kind of looking through a lot of the bad data we're seeing right now and saying, you know what, we think things are going to be better in 3 months, 6 months time, or in a year. So things are slowly but surely, with the stock market very quickly coming back and healing. But even on the economic front, we got a couple of data points this week that point to an improving trend. We kind of talked about this last week with the demand for gasoline picking up. Well, this week, the Conference Board came out with their index of consumer expectations, and consumer confidence is obviously still down a lot from where it was, even though things are getting better. I mean, we're, in a very, very uncertain environment, but the interesting thing this week was the expectations part of this survey picked up this month. So we are starting to see some improvement in consumer behavior, consumer confidence. And then yesterday, Thursday, we got unemployment claims again. They come out every single week. New claims were down again, but are still really, really high when you look back over history. But the interesting thing this week is that continuing claims. So these are people that filed for unemployment before and have been on unemployment for a couple weeks. Those numbers actually came down quite a bit. A couple million people came off, so they're not receiving unemployment anymore. There's a lot of reasons why that could be. They may have quit the workforce or something else might have happened. But what this is really sort of indicating is that as states start to open back up and businesses, small businesses are allowed to go back to work and everything, people are going back to work now. So, we're obviously a long, long way from where we were in February. So, we're not, counting our chickens or anything quite yet. But, again, it's the theme of things are starting to get better. People are starting to go out. Businesses are starting to open up. I mean, here in Illinois, a lot of businesses that have been closed since mid-March are able to open today. And so things are slowly but surely getting better. And then, another indicator we look at on the next slide here is, and this has really been kind of surprising, and I've noticed it in our area even, because I like to track home sales and all that. Home sales have actually, while they're down, they are actually not that bad. And this week, every single week, the Mortgage Bankers Association, the MBA, comes out with an index of new mortgage applications. And, not only have new mortgages picked up a lot and have created a new high for this year, but they were actually the highest level that we've seen for several years. And, I'm sure if we actually pull this back, this is probably the highest week of new mortgages that we've seen since before the housing crisis. And that's really interesting. I mean, when you kind of think about everything we're going through and where unemployment is, that, people are still buying homes is really remarkable. And, I think that's really due to the fact that, maybe increasingly, as we saw in the previous slide, people are starting to go back to work. So the sense that, the economy had a very hard stop, but could have a very quick rebound. People are feeling more confident about that. But also mortgage rates themselves have hit almost all-time lows. I mean, we have data going back to the late 60s, early 70s, and mortgage rates have really never been lower than what they are right now. So the average 30-year mortgage rate is right around 3.2%. So if you've been thinking about getting a mortgage or refinancing, now is a very good time to do that. But all these indicators on the, whether it's continuing unemployment claims or, these mortgages here, this is all pointing to a better environment. So, we're encouraged by that. As I continue to stress in our weekly blog, we have a long ways to go. A lot of damage happened to businesses. Layoffs are still coming. So like bigger companies like airlines are starting to announce more permanent layoffs. So we're not out of the woods by any stretch of the imagination. And we still have to remember that, there's a real risk to our older populations and people who are sick from this virus that is still out there. So we're not out of the woods, but at least it seems that with the summer months, people are starting to kind of come out of their homes a little bit, and things are starting to get better at the margin. So, take that for what it's worth, and, it's good to see.
Yeah, great. Thanks for explaining that, Rob. I think it's helpful. One thing that was interesting this week, as we had posted what we were seeing like on mortgages or refinancing and just people still buying and selling homes. I noticed we had a lot of comments of people saying things like, we've moved, we've bought, we've sold homes during this time. So it's amazing how many people are still feeling the ability, like they're still feeling encouraged or hopeful, optimistic enough to say, we were going to move and we still are. So that's been encouraging to see. So
Yeah.
That's great.
Yeah. And I think, a lot of that, if you kind of slice and dice the data a little bit, a lot of the job losses regrettably have happened, kind of at the lower end of the income spectrum. So people who work at restaurants, and in retail, we really have not seen a lot of job losses from sort of white collar or more corporate type jobs quite yet. So, that's the amazing thing is that, there are people out there buying homes, and you would think, who has the confidence to be able to do that in this environment? But, again, I think it points to something, along the lines of people who were earning a good income, or maybe in a corporate job that isn't as, that's maybe a little more insulated, where you can work from home and do things like that. They're doing fine, and they're looking at mortgage rates that have come way down and thinking, what, if we're going to move, it's the spring selling season, mortgage rates are at all-time lows. So, it's an interesting dynamic, to say the least.
One thing I think of is during 2007, 8, 9, during that time period, real estate obviously took a big hit, and a lot of that was led by banks. But it was interesting because people weren't, moving. A lot of because their housing prices, like the price of their home, had dropped so much. During this, we haven't necessarily seen the price of homes drop. Mm-hmm. So I feel like people are saying my home is holding up. It's an asset that's holding its value. And so, they can sell it and still move somewhere and not take a big hit on that. So it's interesting. Sometimes, completely different situations and all brought on by different things, but it's interesting just some of the factors that are different. So
it is. And, if you're old enough, before the housing crisis, home prices never went down nationwide since the Great Depression. So, this idea that, your home asset is a stable asset, that prices don't fluctuate and go down a lot. Prior to the housing crisis, that was taken for granted. During the housing crisis, obviously, we saw home prices come down a lot. But as we're seeing again this time around, home prices, as you say, are holding up pretty well. So, maybe that's a sign that we're going back to that old paradigm where you can at least count on your home holding its value regardless of what's going on in the general economy.
Yeah, that's great. Always good news. So that's been nice that you've been sharing some good news, some things that we're finding. So I think that helps to people to feel like, okay, we're working through this over time. So thank you for those bright spots.
You got it.
All right. Okay. So we're going to shift a little bit. We're going to change gears here. We have gotten a question in the past week specifically about the PPP and the EIDL loans. So if you're a business owner and you may have applied for one of these types of loans or funds, but not the other or both. One question we got was, and actually, I'm just going to let Trevor walk us through this. He's going to explain this because it is kind of confusing. There's a lot of moving parts, and I think that's where some of the confusion comes from. So Trevor, why don't you go ahead and explain it?
Yeah, happy to. Thanks, Michelle. I would echo that sentiment that things have been very confusing with various different programs and the different terms and the different abilities with each of these programs to be used. It's really confusing to say, well, which one is actually the best case for you or your business? I want to delve directly into a question that we got, as Michelle alluded to, and just kind of read it here. So I just got approved for the EIDL, but I'm confused on whether it needs to be paid back or not. I already got PPP and I applied for EIDL the day it became available. It sounds like there's a couple of different things going on here. The person that asked this question, they highlighted both of the big major programs right now. And that really is the EIDL, and then the other one is the PPP. So down below on that slide, you can see that I've kind of broken it out into three major types, because with the EIDL, there are actually two separate things to be mindful of. First is the grant. So the grant is what you actually get when you apply. Now, per the CARES Act, it was supposed to be paid within 3 days of application. Realistically, we weren't seeing that happening, but in reality and following guidance or whatnot, payments did start to be made, and it basically got reduced from what people were expecting of $10,000 down to $1,000 per employee. The good news with this grant, though, is you don't have to pay it back. It's essentially as if, hey, I'm going to go apply for an EIDL loan, regardless if you get approved or you don't, or if you get declined, or even if you decide not to take the EIDL loan, you can actually get that grant, and it's $1,000 per employee. So there are no terms with it. You don't pay it back. It's just $1,000 per employee. The second portion of that is the actual EIDL loan, and I apologize, I've got a typo there on my slide. But this is actually a separate thing, and more or less it's to say this is an actual loan. So in the same way that Rob was alluding to mortgages for your home, this would basically be a loan that is for your business. You do have to pay it back. And the grant is separate from this loan amount. Now the terms on this loan are actually pretty advantageous. So it's a 3.75% loan for 30 years. And there are certain thresholds with which it can actually be, you don't have to be personally guaranteed for these funds. So if you don't end up paying it back, there are options that, it's not going to destroy your credit or whatnot. So those are the two big programs through the EIDL. The third is the PPP, and this is what's been getting a lot of the media attention here recently because of the forgiveness option. So the way that we calculate how much PPP you can get, it's always 2.5 times your monthly payroll up to $10 million. So you used to see some media articles where there are big companies like Ruth's Chris or Shake Shack getting these massive $10 million PPP loans. And a lot of people were upset about that because maybe they shouldn't have been, because this was supposed to be for small businesses. And Ruth's Chris and Shake Shack aren't exactly small businesses. It's since been that a lot of these companies have paid those funds back. But for your purposes, if you're a small business and you could benefit from these funds, that's how we can get to how much is available. You might have to pay it back, which we'll get into here in just a second. But assuming that you had to pay it back, the terms are pretty straightforward. It's 1% for 2 years. So a shorter time period, but also a reduced rate as well. So that's kind of a rough outlay, excuse me, of all three of the kind of options, more or less. I think it would be worthwhile that we could actually go into an example and just use really rough numbers to see what it actually might look like for you and your business. So this is just a made-up case that we just kind of came up with here today. And thinking through it, we've got a business owner, they're a sole employee, and they made $96,000 in 2019. So how do the numbers in the different programs shake out? So first and foremost, let's say that this business owner applied for the EIDL as soon as it came out, similar to our question asker. So the EIDL would be granted of $1,000 because they're a single employee. Then they could also apply for a PPP loan, which they would do through their bank or their local credit union. And there'd be a lot of questions on how to get through that and whatnot. And I think we've touched on that a little bit, but we can also help you detail that a little bit more if you'd like. But in short form, they'd be eligible up to $20,000 for a PPP loan. And that's just 96 divided by 12 times 2.5. Now, when it comes time to see how much of this do you have to pay back, because that PPP is a loan until it's forgiven. So the forgiveness amount is reduced by your EIDL grant. And what I mean to say by that is you have a $20,000 PPP loan, but because you also received your EIDL grant, the maximum amount that you could be forgiven under the PPP would be $19,000. Think of it as if you're getting free money from the government of $1,000 in the EIDL, and then you're going to get free money of $19,000 from the government from the PPP, but they won't let you go above 20. Is more or less the thought process there, the maximum amount through your PPP. Now, for the remaining $1,000 that you have left on your PPP, you can pay it over 2 years at 1% per the terms we mentioned before, but you could also do it earlier. So let's say that you had the funds available, you don't necessarily need them, you don't want to incur that interest. You can prepay that now. There's no prepayment penalty, and it's just taken care of.
So I think this is helpful, Trevor, to understand like the different moving parts of it, and that both of these loans come from different places. So when people have questions, like specific questions of what is forgivable, or even when they go through the process of what's forgiven, for the PPP, they'll actually go to their bank, so their financial institution, wherever they borrowed from, they're going to be the one deciding what amount is forgiven, right?
Yes, in short form. Now there is guidance to say what's allowable from an expense standpoint. So, excuse me, from the forgiveness portion, if you use at least 75% of those funds for payroll purposes, and then basically up to 25% can be used for rent or utilities and some other ancillary expenses, you can get the full forgiveness, again, reduced by any EIDL grants that you may have. So the guidance from the Treasury Department that basically lay out, say, here are the types of expenses that we're going to allow for when you apply for your forgiveness, what's actually going to be accepted as a forgivable expense. Now, you will need to coordinate that with your institution who you got the loan from, but thankfully the process has been relatively processed down now, so it's pretty well systematized. So hopefully you don't have many concerns or issues, but if you do and you want to walk through it with someone, please let us know. We'll be happy to walk through it with you.
Great, thanks. Yeah, and I think that's the thing. It's kind of like where you've gotten it, and then knowing how much is taxable, and even just the process of which loan you apply for first. Knowing that they can be used for different expenses, things like that. There's a lot to be careful of, and so those are things where if you have questions, please reach out like this person did, and we're happy to even clarify these things more. So thank you, Trevor, for explaining all of that. And hopefully that's helpful, because I think when they asked, there's a lot of confusing information out there. So different sources say different things, and they were just finding that they couldn't get a clear answer. Mm-hmm. So this is helpful.
Yeah, and I think another important thing to add to that would be the PPP, the Payroll Protection Program, was specifically for payroll. And you had to at least use 75% of that to be forgiven, to even qualify for forgiveness. The EIDL loan or grant is much wider. It doesn't have to be used for payroll necessarily. There's other eligible expenses in the business that it can be used for.
Yeah, yep. And those were the things I think when we were really digging in the beginning, it's you have to figure out for your business what makes the most sense. What's the timing of your expenses? What's the amount of each of those expenses? Because obviously if you can get the PPP that's forgiven, do you need to mess with the EIDL? Is it worth it? And so those are some of the questions that even if you've gotten it, like Trevor was mentioning, can you give those funds back? And I think that's where a lot of the businesses that did give the funds back, that were larger, that did have larger loans, I think that's helped to make funds available now that people did that when they could. So as far as we know, they're still there. So that's helpful. All right. Thank you, Trevor. All right, so we're gonna move on. Steve's gonna talk us through just some tax thoughts here, a little bit different this week. So Steve, I'll let you go ahead.
Yeah, as far as the Payroll Protection Program, the PPP, that is still open, eligible for you to apply if you haven't yet, or if your application is in process, hasn't been granted, there's still funds available. And to answer the prior question about the EIDL, that actually has been closed for all applicants except for those in agriculture. So farmers, for example, that program is still open for them. For the everyday small business owner, it's been since closed. So that's the status on the PPP and EIDL. So if you haven't heard, I'm sure your bank will be reaching out to you soon to let you know where you stand in that process, but it's still available. This past week, we worked with actually a handful of clients adjusting their tax withholdings. So each paycheck, you have the option to elect how much is taken out for federal and state. So one great thing to look at would be look at your prior tax return. Look at your 2019 tax return. If you have a large refund, or maybe you had a large balance dues, maybe uncomfortable either way, you can adjust those. And that's done through what's called the W-4. So the federal has their own form. Each state, like Illinois, has their own respective W-4 form. You'll fill it out. It'll adjust how much is taken out by your employers for tax purposes. And that way you can really narrow it down or zero it in so you don't have a large refund that's locked up until you file your return, and you don't have sticker shock of owing a large balance next year when you file your return.
Thanks, Steve. And I think this was really helpful because sometimes it's kind of a guessing game of how many allowances, what do you put on here? So I know you spent a lot of time really digging into this to say, how do we figure this out? So
yeah, and it's actually gotten, from the federal standpoint, it's gotten easier in the sense where there's a new form. There's a 2020 version of the W-4 where allowances, meaning the number of people claimed, is taken away. It's all now based on, do you have kids? How old are you? What's your filing status? And then what are your deductions? So a little bit more friendly of a user form, but still, if you have questions, this is what we do every day.
Great, thank you. And I think this is helpful because this is an idea where if someone has had their income dropped, they have lost income, maybe they've been on unemployment, but that's, this extra amount of the $600 a week will be going away at some point. And so if you're really looking at where can I increase money that I'm keeping, and you do get a refund, this is a way that you can be keeping that money that you would normally get all at once at the end of the year when you file your return. You can be keeping it now. So it makes sense for some people as a way to keep more money today to use for expenses. Thank you. All right, so those were a few different things that we thought we had heard kind of that would be helpful. Just as a review, I'll just wrap us up here. Letting you know, just reminding you of these resources that we're continuing to create. We've done a few different reviews with different professionals because we know that you need help getting these things done. Even though we don't sell insurance, we don't write estate planning documents, we don't do mortgages, but we know that you need these things. And people are thinking about refinancing, for example, or they're thinking, should I be changing my auto insurance since I'm not driving as much? Or how do I get a notary? Or can I still get estate planning documents put in place? All of these questions, we wondered the same thing. So that's why we reached out and asked these specific questions of these professionals that we know do a great job working with our clients and will take great care of you. So they're considered part of our team when we refer you out to them. So these are some videos you can find on Facebook. They were live videos. and then just our market updates. So as Rob writes every week, we send a Friday email. He writes that just kind of talking you through similar things that he talked us through at the beginning of this call. What's he seeing? What are things we should be aware of as we're investing? Then we created, kind of back at the beginning of all of this, when the CARES Act came out. It seems so long ago now, but right when it came out, we created a 15-page document, and each page is devoted to a different section of the CARES Act. So it's not 15 pages to get your answer, but it's each, broken up so that if you have a specific question about your RMD, for example, there's details there that you can see just on that page to get those answers. So if that's something that would be helpful, we're going to link to all of those in the details, the description of this video. And just that's a great summary. One other item I just want to show you, this week it's going out, just being sent out, our monthly newsletter that we send, and we go in a little bit more detail. Rob's writing this month about the Fed and kind of the history of the actions that have been taken there, and then just some other financial planning topics by Rob and Steve. You can see those. So if you want to get on that list, here's our email address. You can just send an email to our team there, or if you want to find any of these are also on our website. So please feel free to reach out if any of these resources would be helpful, but we hope this has answered someone's question. And if you also have questions, please just send them in. We're happy to talk through the answers.